Good afternoon. Minute or so before noon. I want to welcome everybody onto the call. We're going to look to start in about a minute or so. As my clock rolls over to noon on my computer, we'll just give it an extra minute for everybody to join. Thanks for tuning in today on this fine fall afternoon. This is our first call since we have transitioned onto the independent platform. I'll share with everybody on the call that we have had a very positive response, and the office has been very busy. Our team is working diligently to continue to stay caught up with things, but they are a little bit behind. So if you are waiting on announcement of your transfers to come through, I assure you they are in process, but we ask for your patience on things. So why don't we go ahead and get kicked off? I'm here today in my office with Bobby Labaldini from John Hancock.
Good afternoon, everybody.
And why don't we go ahead and move forward? There's our intro slide, and let's move up to our agenda. So topics we want to cover today. The first is, of course, it's in the news, the war breaking out in the Middle East. We also need to spend a couple of minutes talking about the government shutdown and a potential government shutdown, discussion of it and kind of what's leading to that. We want to spend a little bit of time talking about the economy, looking at the different topics that are shown there. And then also we'll wrap up with where we believe there are some opportunities in the marketplace today. So starting with the first topic here of the war, there really aren't any slides that we can use to illustrate this. This is all very new. We've had some stuff before about Ukraine and how it is really, I believe they refer to it as the breadbasket of the
very commodity driven.
Yeah, of a big part of the world. Inflation is still very high in Europe, and in no small part driven by the higher commodity prices on things. They got a break last year with a mild winter. There was a concern that energy prices were going to skyrocket due to the lack of production coming out of Russia, right? Because they were refusing to buy from them, right? So we'll see how things go this year. Let's go ahead and move forward, though. The big issue with the Middle East is the presence that tech firms have in Israel. Pretty much every single big tech firm has a big presence there. And we are expecting we may see some volatility just out of slowing down, getting things done, as it were.
And what I'll say about the Israel crisis is a lot of this is clearly is geopolitical risk, and it's tough to price in geopolitical risk within the market, which is why a lot of times when you're building portfolios, making market predictions, you try not to price it in. A good example of that is really since the crisis starting on Sunday, the markets in Tel Aviv on Monday and Tuesday were actually positive. The markets in the U.S. were actually positive, which seems kind of counterintuitive given the crisis that's gone on there, which is another example why that trying to factor in geopolitical risk as it relates to the market is tough to do. It's actually near impossible.
It's a market timing issue is what it is. Yeah, trying to time it along with the news. So let's take a look at the government shutdown. It kind of refers back to the budget, of course, because these are all just arguments about money. I put an arrow here indicating the government's current budget. We show a $1,400,000,000,000 shortfall, or roughly 23% of spending. That is money that we're having to borrow each year. And I've also indicated over on the right-hand side, we've got the forecast of, you can see my cursor, that this isn't expected to slow down any point in time in the near future. We are looking this year to cross over sometime very soon, if we haven't already, where our debt is the equivalent of 100% of our country's GDP for a year, which is always kind of an issue to try to figure out, is this a turning point, or does it really matter on things? And a trillion just seems like a number that's hard to fathom. So I actually asked Google, how long is a trillion seconds? And the answer is 31,710 years. Our government's total debt is $33 trillion. So I guess if you multiplied 33 by 31,710, it would tell you how many years it would take for us to pay off our government's debt at $1 a second. We're adding an additional $1.4 trillion onto that debt each year. But the crazy thing is that we owe the vast majority of all this money to ourselves. So what that means is the Social Security Administration has bought treasuries. They're the largest holder of United States government treasuries. The different governmental agencies own treasuries. The Federal Reserve owns a bunch of treasuries. So we owe ourselves a bunch of money that we need to come together and try to figure out how it is that we're going to get it paid for. The threat of the government shutting down is nothing new. These are actual government shutdowns. We see as far, or rather as recent as 2018, about 5 years ago or so, that we were shut down for 34 days. A lot of one-day shutdowns out there. Typically, what we see is things going right down to the wire, just like they did a couple of days ago, and then we get a stopgap effort to give us 45 more days to figure things out. As Bobby's already said, trying to figure in geopolitical risk on anything is almost impossible. Lord only knows how things are going to work out with the House of Representatives and what they're going to do for speaker. But it's always going to be interesting, that's for sure. I guess my biggest point with this is we really don't need to be worried about this because we've been through this before. We're jumping ahead on things. The leading economic indicators, this is actually information we get from John Hancock. Bobby, since you're with John Hancock, I'll let you walk us through this.
Yeah, so basically at John Hancock Investment Management, we're what we call kind of cycle investors. And what I mean by that is we're trying to figure out where we are in the economic cycle, right? Are we early, mid, or late market cycle? And the number one factor that we use to help us figure out where we are in the economic cycle is what's called the LEI index, or the Leading Economic Indicator Index. Now, what is the Leading Economic Indicator Index? Well, on the right-hand side of your screen, you can see the different leading economic indicators that we use. Essentially, there are 10 leading economic indicators that get published on a monthly basis. The top line item there is weekly manufacturing hours worked. So an example of that is before a company starts laying off employees, what do they generally do? Well, they generally start to roll back their hours.
Yeah, cut back
before they start the rolling back. And so these factors are just good indicators of what businesses are doing, which gives a nice, at least clearer lens of what might be coming in the future. Now, one of our third-party strategists that we work with, called the Conference Board, they did something really neat. They created an index of those 10 leading economic indicators. And that percentage weighting that you see next to each of those indicators represents the percentage weighting of those factors in this index. And on the left-hand side in the graph, essentially we plot the performance of that index on a monthly basis. So those bars are each kind of monthly numbers going back to 1970. Essentially, blue is bad. Blue means the index is downward trending or the economy is contracting. Green is good. Green means the index is upward trending or the economy is expanding. Each one of those gray bars that you see there represents the last 8 recessions that we've been in since 1970. And almost every time the bars go blue, the index goes negative, it comes before the inevitable recession. Fast forward all the way to the right, where we have that arrow cursor there, you can see that the bars are blue. They've been blue for a long time, and they're deeply blue. They're deeply negative. Essentially, the leading economic indicators index went negative in July of last year. Now, on average, the leading economic indicators go negative for 16 months straight before we hit the proverbial quote unquote recession. Right now we're on month 14. So I don't know if we're going into a recession or not, but what I do know is that we're in a definitely slower growth economy, potentially a recessionary economy. And that's kind of where we believe we're still in this kind of late market cycle.
And as the text says right here for us, that we forecast that the U.S. economy is likely to be in recession from the third quarter of 2013 or 2023, which we
just ended,
to the first quarter of next year. And the reasons behind it: elevated prices, tighter monetary policy, harder to get credit, and reduced government spending are poised to dampen economic growth further. These all tie into the themes of what it is that we're gonna look at here this afternoon. So, um, not always a strong or a perfect predictor on things, especially timing on things, but
Good
um,
gauge.
we've known, and we're going to see a couple of other things that tell us we're getting real close here to knowing where are we with this whole situation. Okay, so taking a glance at inflation, the arrow here on the left shows us clearly that things are coming down, broken down. And those of you that I've met with personally over the last 90 days, we've looked at this. We just have new information. The where it goes below the line there on the graphs, that would indicate that the numbers are actually favorable, right? And a reminder on this: this does not mean that prices are going to come down. It means that the price of things has slowed how fast it's going up. The things below the line do actually indicate the fact that prices are coming down. So we would see that in energy, in green, and new and used vehicles in red. I think after having been through the fact that there were no vehicles to sell, we all kind of welcome the car dealership commercials on TV again saying, we're making deals, right? We're below invoice, we're inventory reduction type stuff. So inflation is certainly coming down. We did have a surprise recently. I guess that's job growth. We're going to get to in a second. Taking a look here now at the consumer saving and borrowing. When we look over to the right hand side, that the light blue mountain chart there shows the reduction in cash that's in the consumer's bank account that's considered excess savings. This majority of this came from the stimulus checks, and we see the spikes there where the money went out. We see that the excess savings crossed over a total of over $2 trillion. And we've been looking at this for the last several quarters. That number is coming down by around 150 billion a month, and zero point 0.2 trillion would indicate there's about 200 billion left. So as I was just alluding to, sometime in the very near future, we're going to find out if the consumer is actually running out of money. The chart right below that, the revolving consumer credit outstanding, indicates that the consumer's percentage of disposable income is rising back up the amount that they've committed to their revolving debt. But if we look back to where we were in 2008, backing up to over here, we see that comparably, the numbers are actually much more favorable than they have been, which tells us that the consumer actually probably has some extra borrowing room that they may continue to be extended to extend their credit on things.
I just had one thing there.
Please.
Um, so excess saving has basically been all that excess saving from COVID has basically been wiped out. We're basically back down to 2007 levels. But what's interesting is that retail sales are still at all time highs. And so if you think about it, if all that excess savings has been, basically gone
Spent.
away, spent,
Yeah.
yet they're still spending, where are they putting all that money then? They're putting it on their credit cards.
Yeah. And we've got something else that's starting this month, which is student loan repayments are back, right? And we're going to take a look at an interesting statistic on that in just a second. Depending upon which economist you listen to, that's forecast to be anywhere from 0.2 to 0.3% reduction in GDP, because the money's going to have to go to loan repayments as opposed to going to the mall.
Yeah.
Per se. I guess you don't go to the mall today. You go Amazon.
Amazon.
Right? Spending on Amazon.
It's an average of $400 per consumer, though, which $400 per consumer per month, that's a lot of money.
That's a lot of money. It's a car payment for a lot of folks. So as I was alluding to just a minute ago, if we look at the bottom right-hand corner chart here, we see flows into early delinquencies. Orange being the student loans, which it's been really tough to default on student loans when you didn't have any payments to make. But we see the car loans starting to rise, credit card starting to rise. And then above that, we also see household debt as a percentage of disposable income rising. Now, this isn't just credit cards, this is all debt. And when we see 30-year fixed rate mortgages approaching 8%, we know that the homeowner or the new home purchaser is having to commit a bigger percentage of their cash flow each month into their mortgage payment. Everybody's looking back and saying, where's the 3%? And there's a logic out there that I've heard some mortgage folks say of, well, folks are just going to wait until interest rates come back down into more reasonable numbers before they buy any real estate. I don't know that that's going to be happening anytime in the near future. The 3% and below interest rates that were available in the debt market were created to stimulate the economy. They were created by the Federal Reserve and through quantitative easing. So um, we could be in a higher for longer interest rate scenario here. Next thing that came out, this was the one I started to touch on a minute or two ago, where you see the red arrow up here. What we've got here is new job creation, non-farm payroll gains. The expectation was we were going to be someplace close to the 3-month average, which we see there in the little box was about 150. And surprise of surprise, the number came out at 300.
I think it was 310.
Yeah, I was thinking 330, roughly twice what it is that we're expecting. And the market kind of flipped out for a couple of days.
Interest rates rose, everything.
Yeah, the concern was this is going to lead the Federal Reserve to raising interest rates again, and we are definitely going to be in a higher interest rates for a longer period of time position. But yet the markets then bounced back recently, even as we touched on with all the geopolitical
and rates have come back
stuff
down,
going on, and
so.
rates have come back down, right? One of the things we are seeing the consumer do, though, is they're shifting money to the safest place that they can find, feeling that there's a safe haven here. So if we look at this green chart, first go all the way over to the left, bottom left over here, we see this chart goes all the way back to 2000, right? So this is a really long chart, and this is money going into money market accounts. And I put a couple of arrows on here to draw attention to the recent flows here. We see money rushing into money market accounts. And again, I'm going to move my cursor way over here to the left, which indicates this is trillions of dollars again. So on our scale here, we would see probably the better part of $1 trillion has gone into the equivalent of a super savings account.
It's the number one inflow in 2023 has been money markets. Number one in asset class inflow.
And these are, of course, exceedingly short duration positions.
Correct.
The flow there is created by the inverted yield curve. The inverted yield curve is essentially where short-term rates are higher than long-term rates. So if we go back to December of 2021, we see what we would call a normalized yield curve, which is a 3-month investment, pays a very low rate of interest, but the longer we go out onto the timeline, the higher the rate that we're able to get. Everybody who stood in line at the bank and looked at the CD rates, right, knows that this is the way things typically work. But the inversion of things came a year later, 2022, and we see where we are, September of 2023, where the shortest of short durations, this 2 years and below, are actually carrying the highest interest rates. That's why money market rates are as high as they are. Now, this happens because the bond market, investors in the bond market, are avoiding these short-term positions because there's this fear there's going to be this big recession and they don't want to have things too short of maturity. So they're buying longer maturity, 2 years and longer, which makes those prices go up and the yields go down. And the super short-term stuff, everybody's selling out of, which makes the prices go down and the yields go up, right? It's a teeter-totter. The key on this is that this is not going to last. So although there is a comfortable feeling here of the money market account paying 5%, this is not like the old days back in the 1970s and 80s where your savings account just paid 5% interest. I know that there's a lot of money going into this that is truly just excess cash reserves.
Yeah,
right?
it'd be like from a bank that's not yielding anything. So
yep. And we've got a number of clients that I've said, if this is money you're going to want to use for your new kitchen or a new, some expense within the next year or so, this is a good idea. But longer term income investing, we really don't think that putting money into a money market for long term is going to be something that's going to work out.
It would make it to summarize, it would make more sense to lock in a higher yield for longer,
Yeah.
essentially.
So summarizing our discussion so far today, I've put in white kind of the highlights of things. The war in the Middle East, probably believable, could lead to some tech volatility. In fact, tech has been on a big run over the last quarter. We talked about the big seven or the big eight, as they're called, that are the biggest positions within the S&P 500, and how they are all tech stocks, and they have literally pushed the value of the S&P 500 around. With them being as high as they are, it's believable they could be giving some back anyways.
Yeah, and I think another risk potentially is oil, right? Because if Iran is behind all of this, how does that affect oil prices going forward? I think initially on Monday and Sunday evening, you saw oil prices spike a little bit. Now they've come back. That's something that could be volatile as well, and could be another inflation challenge if oil continues to be a challenge in the
And
Middle East.
one of the slides that we did not include that we've looked at before is the expectation on demand for oil.
Mhm.
And the expectation is a year from now, demand will be about 1.2 million barrels per day higher than it is today. So between Russia and buying or not buying from them, and now potential
OPEC.
problems in the Middle East, OPEC, and all these things, oil could be a scenario where we see prices rise.
Yep.
Right. So the government shutdown, I think we're all in agreement that this is going to pass. It's just kind of politics at its worst. The economy is slowing, but we keep adding jobs, so we'll see how that goes. Um, the September surprise, we do not expect this to continue. We think it's a surprise. Consumer spending is our next topic here. It's going to slow down because the consumer is running out of credit, they're running out of cash, and they're picking up expenses that they haven't had for a couple of years.
Yeah, I think with the overall economy, I think the economy has been so resilient because of the tremendous amount of fiscal stimulus that's been put in our economy since really the COVID crisis.
Yeah.
And then number two, just how resilient the consumer has been. I think, going forward, you have to ask yourself, is there going to be this much fiscal spend going forward in an election year? And then number two, how much more can the consumer spend when all their savings is dried up?
Mhm.
And to us, that leads to a slower growth economy, and just factors to kind of keep in mind.
And a couple of things we really haven't touched on. Housing is slowing. Ask any realtor, they'll tell you stuff's not moving as fast as it was. Interest rates, literally on 30-year mortgage, closing out on 8% is making folks look at things and say, I think maybe we're going to need to stay where we are. And this is all the design that the Federal Reserve wants to see in place. I didn't hone in on some data that was on one of the slides talking that gives the forecast of what the unemployment rate is going to be years and years and years into the future. Today, we're floating right around
3.8.
3.7, 3.8. Yeah. And the outlook is 4.5.
Yeah, I saw 4.5.
Yeah. And that means there's just going to be more people out of work. Businesses are slowing down. These are all things that the Federal Reserve wants to try to get inflation down to 2%. Little bit of a side issue here. 2% is an arbitrarily low number. Long term, decades long average through highs and lows of inflation, 2.8.
Yeah, right around there.
2.85, something like that. So to say arbitrarily we're going to push it down to 2, I think they're just setting the expectation that we're going to slow this economy down.
Yeah, and not to get real deep into it, but in the Jerome Powell's language, he's kind of shifted from their target is 2% to their target is on average 2%, which, as we all know, average is a number made of extremes.
Yeah.
And so I think that flexibility in the language shows that we're definitely near the end of the rate hiking cycle. But
something else we didn't spend time on today on the slide is the dot plot, which is the forecast for interest rates. It definitely shows interest rates coming down in 2024, 2025, and beyond by a couple hundred basis points.
Yeah.
So that leads us to a discussion when we look at opportunities. Of one of the bullet points I have there is extending maturity on debt. So as opposed to looking at taking those short-term money market rates and saying this is the place to be, bond holders, bond mutual funds are weighing this whole thing out, saying should we be cutting back on the short term and extending a little bit more on the maturities and effective duration on things, because if interest rates start to come down, the longer the duration on your fixed income, it's going to go up in value, right? So you're going to see some
You have the potential
appreciation
for
there.
a total return, not just
Yeah,
a yield.
correct. Opportunities, we touched on oil. One things we haven't touched on, aerospace and defense. Um, just the amount of conflict that there is in the world, and also the amount of travel that's going on, right? With the consumer getting back out and traveling around the world. Aerospace is busy, and defense, we know money is going to be getting spent on defense. We've touched on extending the maturity on debt, and of course, income investing. Growth may be tough over the next couple of years as the economy slows down and profits are contracting. So taking stuff that's paying us a nice income, whether it comes in off of pipeline companies, right, master limited partnerships, the debt market itself. We've got business development companies, real estate, all sorts of different things. Fully occupied real estate we like the most. So income investing can certainly be a way to go. That wraps up our comments for today. And I'll open the mics up if anybody has any questions on anything. Please go ahead. For those of you who signed in late, we do want to be sure that you know this is being recorded and will be played back. So for anybody who wants to listen to it later. And does anybody have any questions? You can unmute yourself. Okay, well, we are right on our 30-minute mark. Bobby, I want to thank you for coming in today.
Appreciate you having me.
And we look forward to talking to everybody again in January. There's a lot of stuff going to be going on between now and then. And we encourage everybody, if you have a question about anything, please call your advisor, call Alyssa, call Derek, call myself. If you have not heard from us, which you will, but don't wait. Feel free to pick up the phone and give us a call. Thank you much, everybody. We appreciate your time.